Will you be selling more in May, or will you try to ride it through?
We're going to ride it through, but we do think investors need to fasten their seatbelts and recognize that after a very awesome April, we need to prepare for a much more volatile May. When I was on Bloomberg about a month ago, I was very confident that with the Fed unleashing $3.5 billion in fresh liquidity for financial markets, equity prices were heading higher. And I'm still very confident that with Washington's determination to spend what it takes and the Fed's determination to print whatever it takes to get the economy on its feet, we're going to be okay in the long run. We're going to recover from COVID-19. My concern is that the market has priced in all that optimism before we have confronted the worst of the bad news on the economy and on some industries and earnings. There's some challenges and setbacks that are going to be hitting us in the face over the next 4 weeks, and we're no longer priced cheaply enough to just look past all that bad news. That suggests to me that we're going to have some significant pullbacks, we're going to have much more volatility, and we're going to have much more resolve than was the case in April.
Despite the volatility and the pullbacks, it seems that there is a group of stocks that continue to be very resilient. And of course, we're talking about the big digital companies, the tech giants. And it seems that from what we saw from earnings last week, the big companies seem to be getting even bigger. In a post-pandemic world, are these the stocks that you want to focus on, especially after we saw the results from Amazon, Alphabet, Facebook?
Yeah, I mean, it is such a consensus trade, but I have to agree with the consensus in this instance. The only sector of the market is technology, and the only major index is NASDAQ that I think everyone can say with good confidence has had their earnings prospects improved by the whole COVID-19 crisis. And you can't say that about any other sector of the economy. And yet, these stocks are still trading below their February prices. So if we can all agree that their earnings prospects have actually improved because of the transition that's going to happen in the global economy due to COVID-19 and the prospect for future pandemics, and their prices are lower, common sense says that's still a great place to put your money.
For big tech at the moment, do you worry about valuations, or are you more concerned, if you're a longer-term investor, to be looking at safety?
You know, if I'm looking at, the overall NASDAQ index is, right around, depending upon your earnings estimates, about 20 times earnings. In a world of zero interest rates and with, the kind of earnings growth that we're already seeing these companies able to produce in this kind of environment, I think that's not a bad valuation given that their growth prospects. And as you said, they happen to also combine the good earnings growth with the best earnings visibility in the marketplace. 20x doesn't strike me as overly expensive in that environment.
Michael, we may have seen a bottoming out or maybe the start of a nascent recovery when it comes to oil and the energy sector with the curbs taking place as of Friday, and of course watching this recovery in places like China and around the rest of the world as we start to reopen. But is that really just a good time to sell out, to close out your positions when it comes to anything energy related?
I do believe energy was the best performing sector in the marketplace in the month of April, and I don't see a rationale for that, quite frankly. I actually believe that even if we saw energy prices and oil prices return back to $40, $50, $60 a barrel, I'm not really sure that will save the energy sector long term, and I'll explain why. Elon Musk taught us over the last 5 or 6 years that electric car ownership is something we got to experience, and we liked it. And what COVID-19 and the quarantine has showed us is what the world would be like without the smog and pollution caused by internal combustion automobiles. And we like that too. From Tokyo, you can see Mount Fuji for the first time in how long? You can see the hills in Beverly Hills. You can, San Francisco, all around the world, people are seeing the dramatic impact that daily commute in an internal combustion automobile has meant to quality of life. This is a complete, prediction on my part, and it could be wrong, but I believe starting in California and probably moving around the world, there will be increasing restrictions on the use of internal combustion automobiles in inner cities. There'll be more restrictions on when you can commute in with your internal combustion automobile. Cities will fight to preserve what they have seen in terms of their environmental impact of not having internal combustion engines. And that's a huge source of energy demand. This is a 5-10 year trend. This is something that obviously for the next year or two will have almost no impact on the demand for oil. But when investors see the writing on the wall, they run for the exits. And after a 30% rally, I personally would hit the bid.
And what about the fact that the Trump administration seems determined to save the oil industry here? Not to mention that you have the Fed now backstopping high-yield corporate debt. So how much support will all of those measures really supply this industry?
I do think that the Fed in particular can prevent the kind of default cycle that we would otherwise see in the energy patch. But President Trump has got to get any kind of bailout for the energy sector through the House of Representatives. And the Democratic Party has not proven to be very friendly to the energy space. And I think there could be a sense, remember, there is going to be, particularly on those blue coasts, the East and the West Coast, they're seeing what life without a daily commute would be like, and they like it. And I think there will be a tremendous fight to oppose any kind of massive bailout of the energy space. And by the way, that's also one of the reasons why I'm worried about volatility in this coming month. The energy sector is critically important to American manufacturing. It is a source of a lot of high-paying jobs. Any contraction in that sector is going to hurt, and it's going to hurt economic prospects, and there will be no replacement for those jobs in the near term.
What about volatility going into November? We have already seen President Trump really up the ante against China. Are we going to see more of those measures and factors that could be at play during the election cycle? We were talking about these tech giants. Perhaps we could see more antitrust measures in place.
Those are all fantastic. The political risks are extremely high right now. I do think China is doing itself no favors. They are refilling their strategic petroleum reserves with Saudi Arabian and Russian oil. They're not fulfilling their obligations under the Trump trade agreement to buy American energy products. And that's just going to create more distrust, more willingness, as Trump, I think, has shown in recent days, more willingness to basically take them on and make them the poster child for COVID-19. I believe ultimately, these kind of political risks, the market can get through them, but they're another reason for the market to be much more volatile over the next 5-6 weeks than it was in the past. I also think another political risk and sort of environmental risk is that states are going to be opening up in different times, and they may be disappointed at the response that they receive from the American public. Polling is saying about 70% of Americans will be reluctant to leave their homes. We need political structures to increase confidence on American consumers so they'll go back to bars and restaurants and so forth. And that's not in place yet. So there's a couple of elements of political risk that could keep that volatility high for the foreseeable future.